Welcome back. Today we're looking at a market that has been quietly setting up for one of the most dramatic repricings in modern financial history, and almost nobody in the mainstream investment world is prepared for what could unfold next in silver. For years, silver has been treated like an afterthought, overshadowed by tech stocks, distracted by crypto cycles, and dismissed as a relic by portfolio managers who believe central banks have everything under control. But beneath the surface, the structural pressures have been building layer by layer, distortion by distortion, until now we are standing at the edge of a potential break that could move faster and more violently than most participants expect. The key issue is not simply price direction, it is market structure, supply fragility, demand acceleration, and monetary irresponsibility all converging at once. Silver is not just another commodity. It is both a monetary metal and an industrial necessity, which means it sits at the intersection of financial fear and real-world consumption. When those two forces begin pulling in the same direction, volatility does not rise gently. It spikes. Most investors misunderstand corrections in silver because they view them through the lens of equity behavior, assuming pullbacks signal weakness rather than tension building beneath resistance. Historically, silver has never moved in a smooth staircase pattern during major bull phases. Instead, it compresses, snaps, retreats, and then explodes higher in repricing waves that leave late entrants chasing and early doubters stunned. The repeated pattern across decades shows that the longer silver is artificially contained or structurally ignored, the more disorderly the eventual move becomes when pressure escapes. What makes the present environment different is that suppression mechanisms that may have worked in the past are now colliding with physical constraints that cannot be printed, hedged away, or synthetically expanded forever. Paper silver markets can create temporary illusions of abundance, but physical silver inventories are finite, extraction is capital intensive, and mining supply responds slowly to price signals because new production takes years, not months. At the same time, industrial demand is no longer stable or cyclical in the old sense. It is trending upward due to electrification, solar infrastructure, advanced electronics, medical applications, and defense technologies. Each of these sectors consumes silver not as a speculative store of value, but as a functional input that is difficult to substitute without performance loss. That means a portion of silver demand is price inelastic. It continues even when prices rise, which changes how shortages manifest. Instead of demand collapsing when price climbs, fabrication users often secure supply in advance, tightening available float and amplifying price response. Add to this the reality that monetary policy across major economies has rewarded debt expansion, punished savings, and normalized currency debasement as a crisis management tool. When trust in fiat purchasing power erodes, even gradually, capital begins searching for assets without counterparty risk. Gold usually moves first in that process, but silver historically accelerates later and faster once retail and smaller institutional flows join the rotation. The dangerous misconception is that because silver has underperformed at times or traded sideways for extended periods, it is incapable of repricing sharply. History shows the opposite. Silver's most powerful advances have occurred after boredom phases so long that most participants gave up watching. Market memory is short, but structural imbalance is persistent. Another overlooked factor is the leverage embedded in derivative positioning. When large speculative or hedging structures are built on the assumption of stable ranges, volatility itself becomes a trigger for forced repositioning. That repositioning can feed on itself, creating air pockets where price moves gap rather than trend. Investors who wait for perfect confirmation often discover that confirmation arrives only after the majority of the move has already occurred. Timing matters more in silver than in slower assets because liquidity depth is thinner and sentiment shifts are more abrupt. Corrections, which many interpret as proof that the thesis is broken, often function as stress tests of conviction and supply availability. Strong hands accumulate, weak hands exit, and the base becomes more combustible. Mainstream financial commentary tends to frame precious metals through short-term dollar strength or interest rate narratives. But that framing misses systemic fragility. Real rates, debt sustainability, currency confidence, and geopolitical fragmentation play roles that do not appear in quarterly earnings models, yet directly affect monetary metals. When confidence fractures, repricing is nonlinear. It does not polite. Lie wait for analyst upgrades. The uncomfortable truth is that many portfolios marketed as diversified are actually concentrated in the same monetary regime assumption: stable fiat, contained inflation, and orderly bond markets. Silver represents a hedge not just against inflation prints, but against regime shift, policy error, and credibility loss. That is why its calm periods are deceptive. They reflect neglect, not safety. Another layer of misunderstanding comes from the belief that large institutions will rotate early and smoothly if a metals bull market begins. In reality, institutional mandates, benchmark constraints, and career risk delay entry. By the time allocation models adjust, price has often already repriced substantially, forcing reactive buying rather than strategic positioning. Retail investors assume they are late, but historically they are often early relative to institutional flow in silver cycles. The phrase price suppression is often misunderstood as conspiracy shorthand, but market structure alone can generate downward pressure through concentrated, short exposure, synthetic supply creation, and futures market dominance over spot discovery. Even without intent, structure can distort signals, but structure cannot manufacture physical metal indefinitely. When delivery preference rises relative to contract rollover, stress appears. Premiums separate from paper quotes, and arbitrage stops functioning smoothly. That is when volatility regimes change. The next silver move, if triggered by supply tightness combined with monetary fear, would not resemble a gradual commodity uptrend. It would resemble a repricing event. Those events are characterized by disbelief, pullbacks that fail to retrace deeply, and narratives scrambling as commentators search for explanations after the fact. Investors waiting for unanimous expert agreement rarely participate meaningfully because agreement arrives after validation, not before. Risk in silver is real. Volatility cuts both directions, but so is asymmetric opportunity when structural imbalance aligns with macro uncertainty. The greatest losses historically did not come from owning silver too early. They came from dismissing it entirely until replacement cost and availability changed simultaneously. Markets do not send engraved invitations before regime shifts. They send subtle signals first, then loud ones later. Right now, the subtle signals are present in volatility behavior, inventory trends, industrial offtake, and currency policy trajectories. Whether the catalyst appears next month or next year matters less than whether investors understand the setup. Preparedness is not prediction. It is positioning with awareness of asymmetric payoff structures. Those who study past silver cycles recognize a repeating psychological arc: disbelief, ridicule, curiosity, acceleration, and finally urgency. Most participants enter during urgency and exit during the next correction, misreading volatility as failure instead of characteristic behavior. Understanding that pattern is itself an edge. Silver does not reward consensus timing. It rewards prepared conviction.